So this is the second session that we're doing with Thomas. Pretty much we wanted to run through and do some sessions focused around taxes. As most of you guys know, at least in the US here, the tax deadline's coming up for your personal taxes. Tax deadline for businesses already passed last month. So it's a good time to kind of talk about this. We'll probably do more sessions throughout the year as well, because I mean, Thomas will get into this, but realistically, it's a good idea to kind of keep your books up to date throughout the year. You know, really do your taxes more quarterly, than kind of packing it in at the end here. And Thomas can talk about, you know, why that's not fun for anyone to pack it in at the end of the year. But yeah, that being said, I'll pass it over to Thomas. We're gonna again do the giveaway at the end, and he's gonna run through the presentation. So maybe just give a little background again on like who you are and then get into it.
Cool. All right. So my name is Thomas. I am a tax professional. I'm an enrolled agent, the highest credential you can receive by the IRS. I am the owner of Traders Tax Pro. So I help traders and investors with their tax returns, bookkeeping, whatever you need. So today we're going to actually talk about cryptocurrency and taxes in the United States. So again, this is for the United States. Any other countries, you would have to seek advice in your country. So disclaimer, this is not personal financial advice. This information presented is for educational purposes only. And what we're discussing is current as of today. However, tax laws can and do change frequently. So if you're watching this in the future, if you're on YouTube, just make sure that what we discuss is still accurate, because crypto is such a new topic still that things are changing all the time. Questions will be answered at the end of this presentation. We'll leave a few minutes for questions. If your question doesn't get answered, feel free to reach out. My email address is thomas@traderstaxpro.com. All right, so different types of crypto transactions. So these are the type of transactions that we'll speak about today. So first and foremost, buy and sell transactions. Basically, you're trading or investing in cryptocurrency. This also, and a topic we're going to include in this presentation, is using crypto to fund or withdraw from a Forex account, whether that be personal or funded. Then we have swapping crypto for crypto. So, you know, buying one crypto with another. Then we have buying and selling goods and services using crypto. We have earnings from mining. We have earnings from staking. And then we have airdrops and NFTs, both created or created and sold, or bought and sold. All right. Organization is key. As a crypto user, you should be extremely organized, an extremely organized record keeper. Without proper documentation of your crypto activity, it'll be close to impossible to accurately report your crypto activity on your taxes. This is 100% true. I can't tell you how many clients come to me and don't know where to start with their crypto activity. It gets crazy. It can get really crazy because unlike other markets, so Forex, for example, in the Forex market, typically we don't need to report every single transaction. There's so many of them. That's a general reporting, but with crypto, we have to report every single one of your sell transactions, and we need to know where they came from. And you'll understand what I mean by that in a little bit. So there are two different ways to stay organized with your activity. The first one is obviously I recommend this. I honestly require my clients to do this with their cryptocurrency, and that's obtaining a cryptocurrency accounting software such as Zenledger. It's one of the ones that I recommend to people. There are a whole bunch of different ones, Coinly, CoinTracker. But if you are a crypto user, then you need a crypto accounting software. It's the only way to keep track of all of your crypto, especially when you're using a bunch of different wallets, exchanges, etc. Or because I say that because you should have a crypto accounting software, but also I recommend that you have your own books, so to speak, and you can do that by using Excel. So a little bit about Excel spreadsheets. In general, you should have a worksheet or a tab for each crypto that you're involved with. Don't mix your crypto transactions together. You know, Bitcoin, Ethereum, Dogecoin, whatever. Each coin should have their own tab. and their own information pertaining to it. Obviously, I didn't get a chance to create an example Excel sheet. In the future, I might do a YouTube video or something, and maybe I will have an example in there after tax season. Obviously, it's busy right now, so I didn't get a chance to. And then obviously within each worksheet, have a section for buys, sells, mining, staking, airdrops, etc., whichever are applicable to your situation. And the main things you'll really need with each transaction is a date, quantity, basis, which is your cost, what it cost you to obtain that coin or those coins, and your proceeds, which is what you've made had you sold the crypto.
Now, Thomas,
So
I have a question. So can you actually get that from the exchange, right? Can you download that, or you just kind of go into your history, your transaction history? Like, what's the best way to kind of obtain that without it being too manual?
So with crypto, it's a little rough. It's honestly a little different with any exchange. It's really hard to say. I've seen people obviously with a whole bunch of different exchanges. I'll just put this in there. The one that I hate the most, the one that I hate seeing the most is Cash App. I can't stand when people use Cash App for crypto because they basically give you a form that just tells you how much Bitcoin you've dealt with, nothing about when it was purchased, when it was, or they give you, I believe it gives you what the disposal date, but it doesn't give you any other information that you need. So it really depends on the exchange. And in all honesty, the only exchange that I've seen, Coinbase does actually too. So Coinbase is one of them that gives good information. But the one that gives it in the perfect format is Robinhood, which is strange because I don't really care for Robinhood. But people who have crypto within Robinhood, they have a nice little reporting, tax reporting summary that they give. But for the most part, they're not really required to. They're not a security like a stock where they're required to send you a 1099-B. So essentially, the information is the same as a stock, reporting it on a tax return. However, they don't typically have to give you the information that's required, which is why I always ask or require clients to have a crypto accounting software so that they can get the appropriate information. It'll extract everything, especially when people have a whole bunch of different exchanges. They're sending coins over here, over there, and we'll get into that in a little bit, why that's important when you have coins all over the place and all different services or exchanges. It's basically keeping inventory of all of your coins in aggregate. But for the most part, the exchanges give a different summary for tax purposes. And the worst one I have to say is Cash App.
Cash.
All right. Yeah, Cash App. I never even knew that
used Cash App last year, and I can agree that it's been a mess trying to reconcile Cash App Bitcoin transactions.
Yeah, they don't. I can tell they don't care. They just give you something, but they don't care.
Yeah.
And then I think, well, KuCoin is bad too. A lot of clients of mine actually said they've been in touch with KuCoin constantly, and they're having trouble getting information. So we'll see. The best one, like I said, honestly, and I don't recommend anybody use it, but Robinhood had the best
Sucks
reporting.
because Robinhood, you don't actually own any Bitcoin. Like, you can't actually transfer it. You can only own it on Robinhood.
Okay.
Yeah.
All right. Makes sense.
His ass.
Makes sense. All right. So taxes on the sale of crypto. So let's get started into the sale of crypto. So essentially, you will have either a long or short-term capital gain or loss, and I'll get into that soon. So reporting is similar to securities such as stocks. So what you'll need for these transactions is a date obtained. So the date that crypto was obtained, the quantity that you sold, the cost basis, which is how much again you paid or the cost in which you obtained the crypto for, and the proceeds, what you sold it for, what you received when you sold it. This will determine your holding period, long or short term, and your gain or loss, of course. So essentially a long-term capital gain or loss is any crypto that would be held for 366 days or longer. So that it has to be that 1 year and a day. If you hold it for a year, it's considered a short term. So anything 365 days and less is a short-term capital gain. The reason why you prefer to have a long-term capital gain is you get a little tax break. The tax rates for long-term capital gains are much better than short, because short-term is essentially being taxed at your ordinary tax bracket. So we go into this here. So again, short-term gains are taxed at your ordinary tax rate. Long-term gains for 2021. So this is 2021 data. Again, these change every single year. So there is different data already out for 2022. So for example, long-term capital gains tax. So essentially some people will not be taxed on their long-term capital gains. Those who are single and make between 0 and 40,400, married filed joint 0 and 80,800, married filing separate 0 and 40,400, and then head of household 0 and 54,100, and so on. So that's basically how you read this chart. So essentially, majority of people in the United States, especially those who are investing or own assets that they're selling, are in the 15% tax bracket for long-term capital gains. Obviously, if you make above the bottom thresholds, then you increase it to 20, which will still be better than your ordinary tax rate. All right, so we'll talk a little bit about this, the most common accounting method used, and that's FIFO. It stands for first in, first out. So regardless of where you have your coins, or where your coins were obtained, rather, kept, transferred, etc., you calculate an aggregate total from all sources combined. So what I mean by this is, you could have 1 Bitcoin in Coinbase, 2 Bitcoins in Gemini, 4 Bitcoin in your cold wallet. So you have 7 Bitcoin and must know the order in which they were all received for proper reporting or record keeping purposes. So the misconception that I see a lot is, let's just go with this example: 1 Bitcoin in Coinbase, 2 Bitcoin in Gemini, and 4 Bitcoin in your cold wallet. Some people think that if you sell 2 Bitcoin in Gemini, that those 2 Bitcoin in Gemini is what's being sold. But in reality, you need all of your coins in aggregate to figure out which ones are being sold, because you might have, if you're using FIFO, first in, first out, you might have bought that Bitcoin that was in Coinbase first, which means that's the first in, that's the first out. So it's a misconception that just because you're selling the 2 Bitcoin in Gemini that you own and you're holding there, doesn't mean that those are the 2 Bitcoin that you're selling. You got to look at your inventory as a whole.
That's very interesting. I had no idea about, I know about FIFO, but I had no idea that this was, something that you're applying to crypto.
Yeah.
So that's kind of crazy. How do you even go about calculating this?
That's why I honestly, and I'll be truthful, and I'm going to say 98% of other tax accountants are denying clients who do not have a crypto accounting software, because the work that would be, the work that would need to be done in this is not worth it. It would take too much time, especially somebody with, let's just say, 1,500 transactions, which is just average for a crypto user, a crypto trader. 1,500 transactions to go through each of them from all different sources and trying to figure out the math. And we're not going to go into the hard math here, but there's, as everybody knows with crypto, there's tons of decimals. So if you have 5.6299 967 Bitcoin and you sell 1.626794, you get the drift. It can be a mess. So somebody with an average amount of crypto transactions is not worth it to figure out on your own, and that's why usually everybody now requires a crypto accounting software.
So are you gonna get into what the crypto accounting softwares are?
Not really, no. Just in that slide that I did before. So the one that I recommend, again, Zen Ledger. It's all of them are pretty good. There's a few of them that aren't that great, but for the most part, they all do the same thing. It's a very competitive field right now. They're all coming out. So they're all trying to compete with one another. I actually just got an email from one of them, Coin Tracking, who I'm actually listed on their website. I asked a question in the beginning of of the tax season, and they didn't have a feature yet, which kind of deterred me from referring people to them. And they just emailed me and said, we have a beta out, so if you want to test this with some clients, blah blah blah. So I kind of told them too. I'm like, oh, this is really, it's sad. So I may have to refer people to another service. So I guess next thing you know, they kept my name on the list, and they're like, hey, we got a beta for this, UX for it. So yeah, they're all competitive, but they're all pretty good. The main thing that a tax professional will probably need from the accounting software is a list of your capital gains and losses, and essentially the software puts everything in order for you, and usually in the form of Form 8949, which is essentially what's needed to report Schedule D, which is your capital gains and losses. So yeah, it's a big help for tax professionals, because otherwise it would take too much time. Again, there may be professionals out there that are willing to do that stuff, but those may be people who have too much time in their hands, or I've never come across one. And I have actually had many people come to me and say, like, in general, their accountants are just, or tax professionals are just turning them down because they said the word crypto, let alone not even speaking about crypto accounting software. So a lot of tax professionals are turning down clients just as soon as they hear crypto, because they don't want to deal with it. So as long as you have a crypto accounting software, basically a majority of them hook up to your crypto exchanges and wallets. And as long as you input, let's just say, again, Coinbase, Gemini, let's say you have a cold wallet. If they don't support like an API to connect to your exchange or your wallet, then they also give you the option to import a CSV file which you can get from any one of your exchanges or wallets, so that all the information goes in there. And then from there, they put everything in order. So just like this situation here, you have 7 Bitcoin, but it's all over the place. Your accounting software will show you that your Bitcoin balance is 7 Bitcoin, and it'll show you where it's from, when you purchased it, how much fees you paid, everything and anything. There are even some accounting softwares for crypto that will search, I guess, like the blockchain data to look for, I guess, your address or whatever is attached to it. I'm not too crypto savvy. I mean, I know about the tax part of it, but I'm not a crazy crypto person. But they do search the blockchains for transactions based on what you input. So they're really good to have. They're not expensive at all. So obviously, if you're into crypto, then the first thing you should do after this video, if you don't already, is check out a crypto accounting software. All right. So swapping coins. And this is important because a lot of people also don't realize this. I get this all the time, and majority of the things I'm going over, a lot of people don't know. Surprisingly, a lot of people are involved with crypto and just don't know these things. So sometimes, I just had a client maybe 2 weeks ago who had $15,000 in gains and had nothing to show for it, but obviously owe taxes on that 15,000. Why? Because he just took his profits out in his exchange and then bought another coin, and he didn't realize that even though he realized that profit, he's got to pay taxes on it, just because he invested into another coin with his profits. So swapping, and this is important, swapping one cryptocurrency for another will trigger a taxable event in the year that it was done. So an example would be buying 30 Ethereum with 1 Bitcoin. So let's just say, for simplicity purposes, that 1 Bitcoin was $30,000 and each ETH was 1,000. So you bought 30 ETH with 1 Bitcoin. So you sold 1 Bitcoin. Therefore, you must report the gain or loss on that 1 Bitcoin disposed of. You don't have to report the purchase of a crypto on your tax return. However, it's important to note your date of retrieval and cost basis. So in this example, again, you're reporting on your tax return the disposal of Bitcoin because you disposed of Bitcoin to buy ETH. And then in your own records, or if you have an accounting software for your crypto, then it'll notate this automatically. You will have the date of your retrieval as your acquired date for the new 30 ETH you obtained, and your cost basis will be what the value of the Bitcoin that you got rid of at the time. So typically the value of the Bitcoin sold less any fees within your own records. So the good thing about cost basis, by the way, which is essentially, again, what you've paid into it, you don't have to, if you bought $100 worth of Bitcoin and after fees, you only received $95 worth of Bitcoin, then your cost basis is 100. And that means right now you're at a $5 loss automatically due to your fees.
Now,
All right.
so what you're saying when it comes to, I have one BTC and it's worth 30K, and then Ethereum's worth 3K, and then I buy 10 Ethereum, right? So I transfer my Bitcoin for Ethereum. I'm getting taxed on the
Disposal.
BTC if there was a gain on it.
If there was a gain, if there was a loss, then you report a loss. You can deduct your losses. You know, if you have a loss, you have a loss. So if you got rid of that Bitcoin to get the Ethereum and you're at a loss for that Bitcoin that was disposed of, then you have a loss on record. A lot of people don't realize that too. I get that all the time too. Speaking to somebody today, actually, on Instagram, and I kept asking, I kept saying, you know, do you trade? Like, what do you trade? What markets do you trade? Let me know a little bit more about your situation. And then they said nothing. And I'm like, but do you trade Forex? Like, I don't understand. Do you trade Forex? And they're like, yeah, but I didn't have any profits. I just had losses. And we went over this in last webinar. People don't realize that your losses in a personal Forex account are deductible, you know, as long as you have other income to offset it. So just like that, I mean, obviously with personal Forex, you're able to write off your entire loss in a whole, as long as, again, you have income to offset. With crypto, it's essentially the same as stocks, where you have a $3,000 limit per year, but you're able to carry over the remainder in future years. So if you experience a loss, then you definitely have that on record, and your losses will offset your gains initially. And then if there are more losses than gains at the end of the year, then you're going to experience where you're going to realize a loss and report a loss. If you realize a total of 4,000 in losses after gains, so you offset all your gains and you still have 4,000 left over in losses, you'll be able to write off 3,000 of your losses on your tax return, and 1,000 will carry over to a future year. In this case, it would be next year's 2022 tax return.
Now, I have a question. Do you get a lot of clients, or have you had a client that trades with, for example, like Nash Markets or one of these unregulated brokers that's using more leverage and whatnot? And then you're, I guess, using, if you want to write, say, you know, they're using Nash Markets, they did what you said, they had losses, they want to use those transactions to, you know, dispose of that or whatever to offset that. Technically, a US person's is not supposed to be using that leverage, right? They're not supposed to be opening accounts with Nash Markets like above 1 to 50, like US persons are
Right.
supposed to be. So that kind of gets sketchy, right?
Well, yeah, I'm glad you brought that up, because I get this all the time from Forex traders. The first thing they always like to say to me is like, I'm scared. Should I get rid of my unregulated account or whatever? The broker is offshore. It's not regulated in the United States. The IRS, I mean, and I say this lightly, the IRS is essentially a collections department for the Department of Treasury. So they don't really care. Like, they don't care where you're getting your money from, where you're doing your trading, or, you know, what drugs you're selling to get that money, like who you stole that money from. They just want you to report all of your income.
They're just like, if you sell drugs, pay taxes.
Yeah. Yeah. No, and it's crazy, because like they don't care where it's coming from. They just want to make sure you're reporting that income and that they're getting their cut for it. So it doesn't matter if you have an unregulated broker. It doesn't matter, you know, in Forex, if you're using, you know, a lot of people, majority of the clients I've had this year use Hugo's Way. You know,
I will say this though, depending how big you get, it can become an issue, because, for example, for Funded Trader, right? Like, we wanted to interact with an offshore broker to do some of our trading activity for the funded group.
Okay.
And we were advised by our attorneys, even though we had a shell company, you know, overseas, that it was still categorized as a US person's. And say we do a bunch of PR, we start getting featured everywhere, and then all of a sudden the SEC sends regulators at our business, and they're like, oh, what are these guys up to? Like, how is their business structured and all that? And we were trading as US persons with for example, Nash or Hugo's way, we would get
Right.
shut down like immediately.
Wow.
Yeah.
Wow. That's crazy. Yeah. I've never heard of anything like that. And I'm sure it's
And people
probably
aren't aware that's what happened to like I don't quote me on this, but take this with a grain of salt. But that's basically what happened with funding talent. Like a lot of people want to say like, oh, funding talent just, couldn't afford stuff, but like no, they literally
disappeared.
got caught trading with leverage that they weren't supposed to be trading with. Again, don't quote, this is my opinion, don't quote me on this. And the regulators looked into their business and basically shut them down.
Crazy. Yeah, it's crazy. I guess it becomes scary the bigger you get. For
Yeah,
the
but I
most
guess if
part,
you're just like the average trader, to your
yeah,
point, it's not that big a deal.
right, right. If you're a speck on the chart, but yeah, somebody like a big prop firm, then definitely. Or if you're if you're making a lot of money, if you have a lot of money, then be careful. Obviously, go with. What do we
Right.
have? What is the, isn't there only two regulated brokers in the United States, Forex.com and Oanda?
Yeah, I mean, so yeah, you could use a Wanda. It's like 1 to 50, leverage.
Yeah,
And then it
yeah.
comes down to this. I mean, if you do get to the point where like you have to be classified as an ECP to actually be able to engage with offshore brokers if as a US persons. But to get classified as that, you have to be your net worth has to be, I think, 10 million. Um,
Wow.
so yeah, that's like the workaround on it.
Yeah, I remember when I first started Forex trading like 10 years ago, I started with Forex.com because I was just scared that I wasn't going to use an unregulated broker. And I remember they had the separate login and all the separate rules for the high rollers or whatever they called it. I guess you get better options, if you have whatever the amount is over 10 million or whatever it is.
Yeah.
But all right, getting off track. So using crypto as a funding or payout method for Forex trading. So this is a big one. Again, this year I've seen it a ton. People tell me, so I ask them, are you involved with crypto? And they say no. And then they are telling me a story and they're like, oh yeah, well, I have a funded account, or I have my Hugo's Way account. And yeah, I get my this is usually the same thing from everybody. I get my payouts in Bitcoin on Cash App, and I like roll my eyes, and I'm like, only because I heard Cash App. But I'm like, you have crypto activity, so you have to report your activity, so you do have crypto activity.
Okay, so
So
I
yeah,
have a question about that. Say,
yes,
and this is quick, say you're a funded trader, hypothetically. I don't
uh-huh.
mean to get too risky here, but say you just have a Ledger Nano and you
Yeah.
just withdraw to your Ledger Nano from us, from funded trader. Do
Hmm.
you have to classify that like as
Yes.
you should? I
Yeah.
mean, realistically.
Yeah. No, I mean, you have to. And I don't know, like there's talks in the field that I don't know. A lot of people, obviously, unlike stocks, for the most part, like everything is reported to the IRS. A lot of these crypto exchanges are all over the place, and who's to say that it's really reported to the IRS? That being said, everybody always talks about how this is essentially public information, and if you think that the IRS can't see your activity, wherever it is, then you're crazy. Even though people say it's decentralized, in reality, you can look up any transaction anywhere because of this, and that's essentially, the IRS can see this information. So I
I
guess
guess
ethically
I
you
guess what
should.
really
I don't.
comes down to it is we're giving out a 1099, right? Or whatever.
Right,
So we're showing that they made income, whether they're taking it in BTC
right,
or Wise
right.
or
Because at the end of the day, and I'm going to go over this here, at the end of the day, they're paying taxes as income for that amount. The only crypto transaction is the gain or the loss after they sell it, once they've received it from you. You're essentially like an employer can pay an employee wages in Bitcoin, and that's still just wages. You paid them X amount worth of Bitcoin. And to you, you paid that amount. That doesn't change. For them, they have to pay the taxes on the income. And then if they decide to, obviously, if they decide to keep that Bitcoin, then there's going to be a gain or loss because they still held on to it for what, even if it was for 2 minutes. The price of Bitcoin is not going to stay the same for 2 minutes. So even if it's a few cents, technically it's a reportable event. But 2 cents obviously is not. It's going to turn to zero, but it's better than in that case to still have it on your tax return just in
Mhm.
case. That's my suggestion. All right. So yes, you're creating a taxable event, which must be reported on your tax return. Most Forex traders who use crypto as a method to funding your account or as a method of withdrawal do not realize this. So an example, you choose to withdraw Bitcoin and I'm talking about withdraw it from, your Forex account, whatever. You receive $500 in Bitcoin. You then transfer that Bitcoin into cash. So you got rid of that Bitcoin. Let's say you receive 490. So everybody knows there's always fees involved with crypto. So you took $500 out in Bitcoin, and then when you transferred it into US dollar, you received $490 worth. So you realized a $10 loss on your Bitcoin, which is a taxable event. Obviously, I mean, you're not taxed on it. You're at a $10 loss, but you still report that. Who doesn't want to report a loss? You're going to essentially deduct that from your income. So if you received so let's say then, for example, if we turn this around and you actually receive $505, then you have a $5 gain, which is again is taxable and will need to be reported on your tax return. If you're not prepared to become organized and keep your record of all your transactions, while using crypto, don't use it as a method to fund or withdraw. You're going to create a mess for yourself, especially for when that day comes that the government starts to regulate this stuff and create crazy laws around it, and everything is a mess. So that's why I always recommend, obviously you can't get away from it sometimes, and it's incentivized. So just go get yourself crypto accounting software. It's part of the game. It's a cost you're going to have to spend. It's not expensive. Just do it. It'll be worth it in the long run. You'll thank yourself.
Yeah, and I posted in the chat, somebody posted in there like a bunch of different softwares.
Good. Awesome. Yeah. Thank you. All right. So buying goods and services with crypto. So it's becoming more and more popular. A lot more places are accepting Bitcoin. I know a few shops I've been to online that actually give you like an exclusive 25% discount if you use Bitcoin. So they incentivize it, and people are doing it more and more. So if you're buying goods or services with crypto, then you're conducting a sell transaction if you bought something. Therefore, you must report the transaction accordingly. So if you buy a t-shirt online using your Bitcoin, you sold some of your Bitcoin by purchasing that t-shirt. So you disposed of Bitcoin. That disposal of Bitcoin is a taxable event. It's considered essentially a sell transaction. You got rid of it.
Dude, that's wild.
Yeah. Yeah.
That's so bad.
It gets crazy. I know.
Oh my God.
So receiving crypto for now on the other end of it, let's say you are the t-shirt salesman receiving crypto for your goods or services. If you receive crypto for goods or services that you provide, you'll firstly report that income, the value of the amount you received, as earned income, whatever the case may be, however you earned it. If it's just a hobby, then it's just ordinary income. If you're a sole proprietor or a single member LLC, then this will go on your Schedule C. So essentially, you're going to report that income as whatever it is. You received income in that amount, and that's what it is. But now you also have Bitcoin in your possession, or crypto, whatever crypto it is in your possession. So you're going to have a taxable event one day because you got to get rid of that crypto. You're either going to transfer it into USD or you're going to swap it for another one. So you then include that earned crypto to your inventory, and we're going to talk about inventory a little bit. The basis is the value of the crypto at the time it was received, and acquired date is the same date that you received it. So just to explain it a little bit better what I mean by this. So let's say you bought a $5 t-shirt, you spent some Bitcoin, so you spent $5 in Bitcoin, and the person who made the t-shirts rather received $5 in Bitcoin. They're going to, let's say that they're a sole proprietor, so they're going to have $5 of earned income on their Schedule C as business income. But they also have that Bitcoin in their wallet now. So for tax reporting purposes, their cost basis, what it cost them is $5, because they already paid taxes on that $5. So you don't want to be double taxed. So even though you didn't purchase that Bitcoin, you technically did because you paid taxes on the amount that you've received already. So you don't want to be double taxed. And then your acquired date, or the date acquired. So for the purposes of figuring out if it's going to be a long-term or short-term capital gain or loss, your acquired date is the date of the purchase, the date that you sold that t-shirt, that person received it. All right. So let's get into mining a little bit. So mining cryptocurrency, taxable income. So taxable income from mining. Earnings from mining are taxed at your ordinary tax rate in the year received. So let's say you start your own mining rig and you start making $10 a day from mining. You're going to report that $10 per day times, let's say you made an even 10 every day of the week, every day of the year for a full year. So 365 times $10 is $3,650. Essentially, you'll have that as ordinary income. From there, though, every time you earn that $10 worth of, let's just say Bitcoin, so you earned $10 in Bitcoin every day mining, you're going to pay your ordinary tax rate applies to that $10. Then you're going to add it into your inventory, which means, remember what I said earlier, it's all of your coins in aggregate. So it doesn't matter where your coins are, you have your inventory. And that's why accounting software for crypto is important. It keeps track of that. So once those coins are added into inventory, you'll realize a capital gain or loss once it's sold. So your basis will be equivalent to the earned value. So again, you're paying ordinary tax on $10 worth per day. Therefore, every time you earn that $10 worth of Bitcoin, those transactions have a cost basis of $10 because you're going to pay taxes on that $10 already. You don't want to be double taxed as a capital gain, and as ordinary makes no sense. Prevents double taxation. Like I just said, you were taxed on the value earned. You realize a gain or loss with that value as a starting point. That's an easier way to understand cost basis. That's your starting point. So if your cost basis is $10 in a transaction, that's your starting point. If you sell, that earned Bitcoin for $8 and you have a $2 loss. If you sell it for 12, then you have a $2 gain. Your starting point is $10. All right. Now I'm just going to be repetitive a little bit because staking is the same concept. More and more people are staking their crypto, earning essentially what's like interest on their crypto by locking it up or whatever they do with it. Similar to earning interest. Earnings from staking are taxed at your ordinary tax rate in the year received. Again, those earnings will be added into your inventory. So in aggregate of all of those coins in total. And you will realize a capital gain or loss once they're sold. Again, same thing. Your basis is equivalent to the earned value. Again, prevents double taxation. You were taxed on the value earned. Therefore, you realize a gain or loss with that value as a starting point. So if you staked Ethereum and you made $5 off of it, you're going to be taxed at your ordinary tax rate for $5 at your ordinary tax rate. And then that Ethereum that is now in your possession has a cost basis, aka a starting point of $5. So when you get rid of that Ethereum, based on how much you sell it for, your proceeds. So if you sell it for $1, you're at a $4 capital loss. If you sell it for $10, you're at a $5 capital gain. So that's just your starting point.
So that's interesting. So basically, if I made $10,000 on USDC this past year, hypothetically, then I would be taxed at an ordinary rate for the 10,000. And then say USD coin went up, which it won't, but say it did, from the 10,000, from $1 to $1.02, and then I sold it, I would be taxed on the difference between where I got it at.
You started.
Yeah, that's interesting.
Yep. Yeah, so a lot of people complain that you're double taxed on it, on like staking earnings and all that, but in reality, you're not, because you were taxed up to a certain point. You were taxed up to $10,000, so you're not going to be taxed on that original $10,000 again, just on the gain from that starting point thereof. Get what I'm saying?
That's so interesting. I mean, it makes sense because you're realistically gaining, value from staking.
Right.
And now, is this something that with this software, is this something that can be tracked with software as well?
Yeah, so they track everything, and that's really the determining factor on like which one to use. That's why I recommend Zenledger to everybody. I don't personally use Zenledger. I might use it. I might switch. I'm using coin tracking right now, but I don't know. I want to try Zen Ledger only because, I mean, maybe it's their marketing working on me, but they seem to offer the most out of all of them. They even not that I do anything with NFTs. I personally don't understand them. I know the tax implications. I don't understand NFTs. They also work with, you know, crypto users who have NFTs, buy and sell them, whatever. So they are well rounded. They're supposedly, they also have connections to a bunch of different exchanges and wallets, and the one that, obviously the one that connects to your wallets and exchanges is obviously the one to go with. It's never fun to have to search for a CSV file in your exchange and then import it in and hope that everything looks correct. So sometimes there are people, and this is an interesting fact. And personally, I don't really get into this. There are some people who will reconcile crypto activity, because I'm seeing more and more people with rug pulls and scams. And so, like, let's say they put $1,000 into some project or coin or whatever it is, and they're promised these coins, and these coins are fake, and so their value in the system is like $1 trillion. These people have accounting software now that shows $1 trillion in gains, and they're like, I don't know how to fix this. There are some people that will do the reconciliations and work with that. You have to have a really firm understanding of the way crypto works for that. I mean, I have a basic, but I don't do the reconciliations like that. I know I've had a few people ask about that. It is kind of hard to find somebody to do that. And again, that's because crypto is annoying. It's just annoying. There's a lot of math and decimals, and figuring out where it came from and what you're going to fix and how it's going to affect everything else. So essentially, that's why I always tell everybody there's got to be a better way. And I'm sure maybe hopefully they'll figure out a better way for, you know, crypto reporting, because at the end of the day, if you're doing everything with, you know, a paper and pen, then it can take you all tax season. If somebody really is an avid crypto user, it can take you the whole tax season to get their stuff done. So but as long as you didn't experience any like crazy stuff that went on, then your account should be fine. That's not to say that, you know, a lot of the time also those people that ask for reconciliations of their accounts are lazy, because you can really go into your own account and fix it yourself. Plenty of my clients tell me that they just took a week or two to go through their accounts and fix it based on, you know, having some rug pulls and bullshit coins. So it really just depends. All right. Airdrops. I'm just going to really repeat myself again. Airdrops are the same as staking and mining. Earnings from airdrops are taxed at ordinary tax rate in the year they're received. Earnings are added to inventory. Then you'll realize a capital gain or loss thereafter with the cost basis of the value in which the coins were at the time you received the airdrop. All right. So let's get into some examples, and they're not too crazy. Some of them will get a little bit in depth, but they're not too crazy. I kept it simple, and just to let everybody know, these values are not accurate. They're just for simplicity purposes. If it says Bitcoin was worth $1,500, then just go with it. That's not going to be true. Just again, it's for the sake of this example. So you have 5 Bitcoin in your wallet from past years. You earn 1 Bitcoin from staked earnings on 5/5/21, valued at $10,000. Okay, so just to recap, we've got $5 in our wallet. We purchased it in years past, and now we just earned 1 Bitcoin valued at $10,000 on May 5th of 21. So you will pay taxes at your ordinary tax rate on that 1 Bitcoin that you've earned. So ordinary tax rate on that 10,000. Now you're going to add that 1 Bitcoin to your inventory, or your total aggregate amount of Bitcoin, regardless of where you keep it, wallet, exchange, whatever. It's yours. It's your property. We don't care. You know, nobody cares where you keep, you know, your gold coins. You can have some at grandma's house, some in your bedroom, some in your brother's drawer. They're all yours, right? So that's a good way of thinking about it. It doesn't matter where it is. It doesn't matter if it's a physical, you know, a physical piece of property, or where you put it. It's still your property.
Now, Thomas, so like, what if and this is just again like me trying to be the the
Devil's advocate.
devil's advocate to this. What if you have 5 Bitcoin and in your wallet, right? And you're with a centralized exchange, so your name is obviously attached to it. Let's say you're with Coinbase, right?
Mhm.
And then you go ahead and you send 1 BTC to anonymous Ledger Nano, right?
Mhm.
Now at that point, can you to the IRS say, I don't know where that Bitcoin went, right?
Uh, they'll, uh, they'll, and so they'll be able to, I mean, that's a really good question. I know they'll be able to see that it was transferred somewhere.
Yeah,
And then obviously if they see that you've transferred multiple times to the same source, they're going to be like, hey, yeah, this is your wallet. We're not stupid.
right.
But that's a really good question. Now, again, my assumption is that they would eventually research it, especially if it was something to really go into and research, if it was a lot of money or if they felt that you were deceiving them. There is, and I have to look into it. I've never actually filed it. I did have a client that was going to do it, but unfortunately, he contacted me after 2022 started, and I told him we cannot do this for 2021 because it's not 2021 anymore. But he did have a rug pull, and you're allowed to, so worthless. Essentially, it's writing off worthless property, but there's a little bit that goes into it. So things like so he had a rug pull, so he put some money into a shit coin that was fake, and somebody took his money. And
Wow.
he didn't receive anything in return, and he's like, oh, I thought I can just write that off as a capital loss, but in reality you can't, because you didn't sell it,
Yeah.
you didn't receive anything or get rid of anything to sell it. And so you can, and I forgot the form number, but you can, as long as you have proof, and people have done this with crypto, as long as you have proof of oh no, I'm sorry, he did receive coins, but they were worth $0. There was no market for them, nowhere to sell it. There was no liquidity, whatever. So it was just a dud. It was just a made up coin that somebody took his money and gave him, shit coin or whatever it was called, and it was worth nothing, and he can't sell it anywhere.
They gave him
Um,
shit stain
yeah.
coin. Oh my god.
So you're allowed
This
to
guy
write, you
goes,
can
it's
write off
called
that loss.
audio money. I don't even know what
What is
that
it?
means, but I don't know. I guess
Oh.
he goes, it's called audio money. He said that with so much conviction that it's audio money must be a rug pull. Like it's gotta
Yeah.
be.
Oh, there's a ton of them, because there's people that contact me all the time that are like, I have these rug pulls, and that goes in hand with the people wanting reconciliations of their crypto accounts. Because I mean, I guess I understand people just want to get rich, and they see other people getting rich in crypto, and I don't think I would go that far as to invest in something I don't really know anything about.
Right.
But it's scary seeing a lot of people lose all this money in these rug pulls. But the worst thing is, like, who are these people selling these crazy coins, and like they must be loaded. Like, this is crazy. You just took money and that's it for nothing. Like, I don't know, it blows my mind. And every day I hear more and more of it, and I never realized that there's so many people out there that are willing to just throw their money into something like that.
Oh, dude, it's crazy. And like the other thing is I forgot the agency, I guess the FBI or whatever. They're actually
Mhm.
starting to look into these rug pulls now and like prosecute people.
Yeah, I just saw here in New York. I believe it was here in New York, or unless it was somewhere in
Yeah.
the nation. But I just saw on the news that somebody had, like, some. I don't mark my don't. I don't know if this is accurate. I'm just going off memory. It was something like $40 million or something worth of crypto. They like stole or scammed or
Yeah,
something.
there was one guy, I think actually out of New York, and they listed it was like the official, I guess, document for the conviction or whatever. And he
Mhm.
had so many aliases that must have been like all of his Discord names.
Yeah,
It's
it's
so
it,
funny.
it's crazy. Like, people are. I mean, talk about catfish. Like, it's crazy. I don't know. I'm like, see, me, when I invest in something, I'm kind of like, yeah, I'm an impulsive person, but at the same time, like with investing or something like that, even with a purchase of something, with this microphone that's in front of you, I don't think anybody understands. I'm like not OCD, but like I've got to do my research for a minimum of like a month before I buy something sometimes. And then like at the end of it, like, I'm kind of like, do I do it or don't I do it? Do I have enough information to do it? Like, I don't know. I never, I'm impulsive in some ways, but in other ways I'm not. And especially with something like that, when people tell me that they just threw money into something and it's gone, like, oh, I couldn't imagine. I would never put myself in that situation. So word of advice, do your research before you buy or put your money into anything. All right. So where were we? All right. So you acquire, all right. So you will add the 1 Bitcoin to your inventory. And now your acquired date is 5/5 because you earned from staking on 5/5. So your acquired date for that $10,000 worth of Bitcoin received is 5/5. Your cost basis or starting point in determining a gain or loss for the future, for future reference, is $10,000. Whenever you decide to sell that 1 Bitcoin for US dollars, you are essentially selling 1 Bitcoin that you've acquired in the past while using FIFO, first in, first out. So like we said in the beginning of this example, you have 5 Bitcoin in your possession from previous purchases. So just because you want to sell that 1 Bitcoin that you earned, you're really not selling that 1 Bitcoin that you earned. It's like, let's think of it as, Hot Wheels. I don't know, like little kid cars, Hot Wheels. Let's say you got 5 Hot Wheels in a row, and now you just earned another Hot Wheel, and they're in the order in which they were received. So the last one in was the one that you earned. But when you're getting ready to sell that 1 Bitcoin, you're really selling that first one in line. That first one in line is going out first because it's first in, first out. Everyone waits in line, first come, first serve. So essentially, even if you wanted to get rid of that 1 Bitcoin you earned, you might not be getting rid of that one that you earned, that literal 1 Bitcoin that you earned. You're getting rid of the first one in your inventory, the oldest one. All right. Example number 2, this one goes a little bit more into depth, so I apologize if I lose you, but that's why it's extremely important to get crypto accounting software. I'll say it again. And these are easy, by the way. I made these easy, and in reality, it's never this easy. There's never even numbers. There's a million decimals, and usually you're pulling from multiple transactions. So, all right. So on January 1st of 19, you purchase 1 ETH at $1,000, and you now have a balance of 1 ETH, your first purchase of ETH ever. The next year, on the same date, you purchase another 1 ETH at $1,500. You now have a balance of 2. The next year, 2021, you purchase another coin worth $2,500, and you have a balance of 3. All right. So now in 2021, we're still in 2021. On 6/1, you earned 2 ETH at $2,000 each for a total of $4,000. So we'll say you earned it from, I don't care, mining, whatever. So on 6/3, so now it's 6/3, 2 days later, you wish to cash out that 2 ETH that was earned. Current price on that day is 2,200. So the procedure goes as follows. First, you must keep record of earnings. So on 6/1, you earned 2 ETH for a total of $4,000. As that $4,000 will be taxed as your ordinary tax rate. You should also keep record in order to make quarterly estimated tax payments, what Angela was just talking about before. Not that it's a lot of money, but tax season comes along, and I'm seeing not only, small business owners who didn't realize they had to pay taxes on their earnings, but now, I see a lot of, I have a few clients who bought crypto, especially this year, especially because the market boomed in the beginning of 2021. I have a lot of clients who just bought minuscule amounts of crypto and invested $1,000 and turned it into $85,000, more money than they've seen in their lives. And they just didn't know that they're going to have an underpayment penalty now, because essentially the IRS is going to assess an underpayment penalty on your tax return because you underpaid your taxes for the year. So if you owe anything more than $1,000, they're going to tack on a fee. They're going to tack on more. You got to pay them more money because you underpaid them, even though they're still going to receive it. They're just getting another fee. So that's estimated taxes go a long way. It's not to say that fee is a lot. It's usually not. for the most part, I usually see people pay anywhere between, 10 and $100 for the fee, but still that's your money that you don't want to just give them because you underpaid them. So making quarterly estimated tax payments, if you don't really understand estimated quarterly estimated tax payments, you can see our other webinar video. It's on the Funded Traders YouTube page. We go into the estimated tax payments a little bit more in depth. Again, if you have any other questions still, email me and I'll help you out. All right, 2, you'll add the transaction to inventory. So again, we're talking about adding it to your inventory, to your aggregate total amount of ETH. Your date acquired is 6/1. So this is what the transact, and when I put these little transaction notes, these are essentially the things that are required for a tax return of Form 8949. Date acquired 6/1/21, quantity 2 ETH, basis, your cost $4,000, your new balance in all in aggregate 5 ETH. Now on 6/3, you sell that 2 ETH. You are not selling the same 2 ETH that was earned. With FIFO, first in, first out, you'll be selling the first ETH obtained in the inventory. Beneficial to you, as you would realize a long-term capital gain and not a short-term capital gain. So if you were a newbie doing your own taxes and you thought you were, if you got the hang of this stuff kind of, and you're like, oh, I just sold the 2 ETH that I earned. Therefore, my acquired date is 6/1 and my sell date is 6/3. You're going to get taxed at your ordinary tax rate now because you're creating a short-term capital gain. When in reality with FIFO, you want to take out the first, if you sold 2 ETH, you're taking out 1 ETH from 1/1 and 19 and 1 ETH from 1/1/20. Both of those are over 366 days ago. So you're going to get a long-term capital gain, therefore being taxed at much less, at a much less rate than a lower rate rather than your ordinary tax rate. So again, what I just explained here, this means you sold 1 ETH from 1/1/19, 1 ETH from 1/1/20, both are over 366 days, therefore allow for a long-term capital gain. So you received a total of $4,400 for this sale because I let you know over here, they were $22 per coin at the time of selling. So you received a total of $4,400. $2,200 for each. So your taxable transaction is as follows, and this is the information essentially needed for your tax return, or this is what a tax professional would put on your Form 8949. Acquired various. So a lot of the times you'll see various. Why? Because we sold 2. However, we don't have a purchase date with 2 in there. So we got to pull it from various 1 and 2. So there are 2 purchases that we're pulling from. So various is the acquired date. Sale date 6/3. Your cost basis, what you put into it total, since we pulled out from these 2, 1 and 2, your cost basis, you paid 1,000 here, 1,500 here. Your total cost basis is 2,500. So your cost is 2,500. Again, we said this over here, you received 4,400 total proceeds. Therefore, the amount taxed as a long-term capital gain is 1,900, the difference between your proceeds and your cost basis. You should have now removed 2 ETH from your inventory with a new balance of 3. So therefore, this guy is gone and this guy is gone. Now we have this guy and we have this earned this guy. First in, first out, first come, first serve. Best way to think about it.
Dude, that's a crazy, guys, long story short, this is why you need to get an account.
Yeah.
Jesus
A lot of people just think that they can wing it themselves. And I'm not going to lie, I'll be completely transparent and upfront. These accounting softwares, some of them will integrate with like TurboTax and like all that, but that doesn't bother a lot of us tax professionals, because at the end of the day, you're not getting the knowledge. You're not getting somebody who's actually putting their eyes on your tax return and saying, like, what can we do here? Like those softwares will just do what's standard by asking you questions, and then honestly, a lot of people don't understand the questions that those systems ask. And the one thing I always hear is like, and this is just from people I know, not from like clients, like, oh yeah, I did my taxes on TurboTax. If the IRS ever wanted to say anything, I don't know taxes, I just did them myself online. Well, you signed that tax return and you're responsible. So, you're still going to get in trouble. The number one excuse that's inexcusable to the IRS is, I didn't know, if you don't know, then don't do it yourself. It's not
Right.
just to say that because I'm a tax professional who does taxes. It's because if you really have a situation where you're unsure of, then just go see somebody. It's money well spent. Um,
It's like not even
well,
that expensive either.
no, it's so worth it because I used to do, before I really got into taxes, I used to do when I was younger in college, especially. I used to do my own taxes on, like, those softwares, TurboTax, whatever. And I used to always say, like, oh, what's the difference? And then, like, my brother, my dad, everybody went to the same guy, and they always boasted about him. And I'm like, what the fuck? What does he do different? Then you, and then the first year I go to him and I speak to him, and it's kind of like, wow, like, okay, yeah, he'll do your taxes, but also, like, you can ask him questions, and you can actually, like he actually looks into your stuff, and it's not just a guessing game and uploading this and answering a question. Should I click yes or no? I don't know. Like, it's just literally, like, it takes a weight off your shoulders. And that's one of the reasons why I started Traders Tax Pro, is because, yeah, there's some other firms out there that do, investors and traders, they're looking for the big guns. But I've been in everybody else's shoes, especially people that are here right now. I've been in your shoes before, as a funded trader, a Forex trader, a crypto user, a stock investor, where it's like, you don't really understand this stuff. A lot of people don't. And it's hard. And so that's why I started it, because they always say, first and foremost, invest in things, but also, like, starting a business, that's my investment. And doing it in something that I know, like, everybody that comes to me, like, I've been in your shoes, I can relate. Like, I've been there. So, like, hearing these people's stories about trading Forex and doing everything, like, we can sit there, not only just talk about taxes. Yeah, like, sometimes I got a half hour that we got to get everything in, but, like, we'll bullshit about Forex sometimes, or, like, where they're struggling. Most of the time it's like psychology things, and people having to learn to, like, not attach their emotions to their trades. And just, I've been there. So it's not like, I'm just somebody who did this. And, I've been in your shoes, and I at one time had no idea what this was about. So
This makes me want to
all
move to Puerto Rico, man, and not pay taxes.
right. Right, I know. Well, I know
Crazy. It's
it's
crazy
crazy.
there because you only have to pay 4% flat tax.
Yeah, I know.
It's
It's
insane.
crazy. It's and it and I don't know if I said this last webinar, like, um everybody agrees. Like, I saw this thing, and they said basically taxes right now are the most complex they've ever been in the history of taxes, which means it only gets worse, because Congress just keeps changing things, and then there's all these different things that even, like, us, when we're looking at a tax return, have to think about. And sometimes you just get, like, caught up, because it's like a maze that leads to the same way in two separate directions. It's crazy. It's really crazy. And then, somebody finds a back door to something, and somebody finds, a way around it. And then the IRS catches on, and then they gotta, sometimes they may have to fix their return. It's crazy. Like, maybe it was the advanced child tax credit this year. So 2021 is a shit show because of the advanced child tax credit, and because of the return recovery rebate, which was the EIP3, the third stimulus payment. So the government gave people advances on their child tax credits in 2021, and people also got their third stimulus payment. Now, these third stimulus payments came in March of last year. Most people received it in March. It's now March of 2022. So you think, when you ask somebody, did you receive your third stimulus payment? They're like, I got the two. I don't know. I got the two that Trump had. Like, well, I'm talking about the third. The third was last year. And the IRS is looking into this shit. Then they're backing up returns. They're slowing down because they're checking on this, and they're changing people's returns on their own this year. If you say no to EIP3, then they're changing your return, or the advanced child tax credit. You got people, who received their advanced child tax credit, and they're not getting their full child tax credit this year on their tax return. And they're like, why is my refund so much less than last year? Well, because you accepted that money. Because you accepted that money, unfortunately. Like, you received an advanced child tax credit. It's an advance on it. It wasn't free money. I mean, essentially it still is free money. It's a credit, but it's a credit from your, filing your taxes that is now lowered. So it's a mess. Yeah, it's crazy. I'm so glad that we have, like, like 19 days left in tax season. This is like how every tax professional gets, like you just count down.
Which is hell.
Yeah, yeah. In the beginning, you're so happy and ready for it. And by the end, you're like, oh my God, is it over? All right.
I feel you.
So example number 3, we'll go over an example of swapping crypto. All right. So on 9/1, on September 1st, you decide that you want to own some Ethereum. Instead of purchasing your Ethereum with money, you decide to purchase it with your Bitcoin that you currently own. So current info. So making it easy for the sake of this example, and I did this the entire time, you only have one Bitcoin, which you purchased on 1/1/21. So your wallet has one Bitcoin in it from 1/1/21 and you bought it for $25,000. On 9/1, so a couple months later, the price of Bitcoin is now $30,000. You want to purchase one Ethereum, which is currently priced at $3,000. How does it work? So you're selling 0.10 Bitcoin to purchase one ETH. Therefore, you have a taxable event in that you disposed of the Bitcoin. So 0.1 Bitcoin, and this is now your transaction data. You sold 0.1 Bitcoin, acquire date 1/1/21, sale date 9/1/21, cost basis, because you had an entire Bitcoin and you only got rid of a tenth of it, what is 1/10 of the cost of $25,000? Your initial cost, 2,500. So your cost basis is 2,500. Your proceeds are 3,000 because you got rid of it at 3,000 because you bought $3,000 worth of ETH. So you have a short-term capital gain of $500 just for buying ETH with your own Bitcoin. So new balance. Now you have 0.9 left Bitcoin and you have, one ETH. So new transaction in ETH inventory. Again, the purchasing of the ETH is not reportable on your tax return unless, of course, you sold it. But if you didn't sell it, then just for your own records, you acquired that ETH on 9/1/21. You received one quantity of one ETH, and your cost basis was $3,000. You don't report the purchases on your tax return, only sales. Now, that's not to say there is a question on the tax returns on page 1 of your 1040 this year and last year, and I believe the year before that, that asks if you were involved with crypto at all. You obviously say yes, even if you didn't sell anything and you'll have no sales of crypto, you still check yes, you were active in the crypto market. So they're checking on that too. I know in 2019, they started sending letters to people who were lying on their tax returns about crypto because they are starting to take a look into the crypto world. So a lot of people receive letters saying, hey, you didn't tell us that you were in the crypto world and you in fact are, we know you are, so you need to change your tax return. All right. I believe this is the last example, using crypto as a method of funding or withdrawing from Forex. So on 1/1/21, you purchased 0.5 Bitcoin to fund your Forex account, $15,000. So half a Bitcoin, $15,000. You purchased it so that you can fund your account. You then transfer it to your Forex account and receive a total of 14,900 after fees. Let's say that you got charged some fees for transferring it over, whatever. So you have half of a Bitcoin that you now, because it transferred to your Forex account is probably going to be in US dollars. You got rid of that Bitcoin right away. So literally you just use the Bitcoin as a vehicle, but unfortunately you've created a taxable event for yourself. And this is what I'm talking about. If you're not too savvy with it, don't use it because you're creating a taxable event that you're probably unaware of. So you purchase that Bitcoin as a vehicle, like I said, just to fund your Forex account. But now once you transferred it to your Forex account, you now disposed of it. And so you had it and it's gone already. So let's say you received it and got rid of it on the same day and it's in your Forex account now, 14,900. So your transaction data is half of Bitcoin. You acquired it on 1/1, you sold it on 1/1. Your cost basis was 15,000 and your proceeds was 14,900 with a short-term capital loss of $100. Now let's say you trade that 14,900 in your Forex account and you make it into 20,900. So you just made $6,000 in the Forex market. And on 3/1, so 2 months later, you want to pull out that $6,000 in earnings. So you just want to bring your balance back down to 14,900 and you want to take that 6,000 you just made. So you decide to use Bitcoin as the method of withdrawal, as the vehicle. So you receive 0.25 Bitcoin for that $6,000. Again, quarter of a Bitcoin for $6,000 of your earnings you're withdrawing. So now you're going to be taxed on that $6,000 earned from income as trading Forex gains. So even though you have 6,000 in Bitcoin, let's say right now, you're taking that out. You're using the Bitcoin as a vehicle, and you're essentially being taxed as ordinary gains because it's Forex gains. So your cost basis is going to be that 6,000. By the time the Bitcoin gets to your account, you sell it and it's worth 6,100. So this happens all the time because Bitcoin's going up and down. Sometimes when I'm dealing with crypto, I know that it takes forever for it to get into my account. Like sometimes literally if I do it on a Friday, sometimes it takes days for my Bitcoin to show in my wallet. I don't know why. It's only happened like once or twice, but still, by the time I actually get it, and it's worth whatever 6,100 now. So your transaction details are as follows. You sold a quarter of Bitcoin. You acquired it on 3/1. You sold it on 3/1. Your basis was 6,000 because you were already taxed on 6,000 as a Forex gain. And your proceeds were 6,100. Therefore, you have a short-term capital gain of $100. Again, that remaining 6,000 will be taxed as Forex gains. That's why we're not being taxing us that crypto as a capital gain in 6,000. All right.
That's it.
Oh.
It's not like anything crazy. Like honestly, like it's the actual, like you're being taxed because you're making some capital gains when you buy and then you sell. Like it's not like you're getting completely screwed, but like from just a bookkeeping perspective, it's
just write it down. Yeah. Like get your crypto accounting software or write this down, write everything down that we went over. These essentially the things that we need, especially if you're not a crypto person. Like just if you are a crypto person, it makes it a little bit harder because now you're intermingling your crypto activity with this stuff. But if you have a good record keeping system like accounting software for crypto, then you're fine. All right. Funded trading withdrawals. So you withdraw 10,000 from your account after prop fees. After they take their cut, you wish to receive Bitcoin. So you receive a quarter of a Bitcoin on 12/20/21. You'll be taxed on that $10,000 as Schedule C income because that is income that you earned from them. So just because you're receiving $10,000 in Bitcoin doesn't mean you're being taxed on that Bitcoin. You're being taxed on that $10,000 that you earned that the funded trader is paying you. By the time you receive it, you sell it for US dollars, and that quarter of a Bitcoin is now worth 10,500. While it was in transit, it went up 500. So you have a quarter of a Bitcoin that you acquired on 12/20. You sold it on 12/20. The basis was 10,000 and the proceeds were 10,500. So you have a short-term capital gain of 500. Pretty simple. Important for Forex or funded Forex traders who use Bitcoin for withdrawals. If you don't simply use Bitcoin for the purposes of being a vehicle, so to speak, and you're also like a fanatic, a crypto fanatic, or you're an avid crypto trader or investor, then obviously you need to go get crypto accounting software if you don't have it.
If you're a
which you
crypto
should.
addict,
Most of
get
them
the
do.
software.
Yeah. You'll need to add Bitcoin into your inventory. Therefore, you would not be selling the actual Bitcoin earned. As explained previously, using FIFO, you will discard the earliest received Bitcoin first. Therefore, it is very much so possible that you could realize a long-term capital gain. All right, moving on, NFTs. So we're almost done. Creating NFTs. If you create NFTs, you will only create a taxable event once the NFT has been sold. So you'll be reporting this income as ordinary income if it's a hobby. If you do this as part of a self-employment type business, you'll be reported as self-employment income on a Schedule C. For the most part, though, people don't do this as a job, so it'd be a hobby. Ordinary tax rate.
Now, can't you technically do some shady shit with that, like where I create an NFT and then I have a random wallet and then that wallet buys my NFT, and then, or I guess that's actually a detriment to you because then you'd have to pay taxes on that sale.
Right. Are you talking about creating NFT or buying and selling them?
I'm talking about like, how do people, I guess people I guess that's like a way to launder money.
Oh,
Like
the NFTs.
make an
Yeah, and
NFT, yeah, you make an NFT and then say you have crypto in a wallet that's not, taxed yet, and then you
right.
buy your own NFT, and then you basically put that in your taxes, like, oh, I sold my NFT for 50 G's, and then you
Well, yeah,
pay one, yeah,
you sold it for 50 G's. So you made 50 G's, but you also spent 50 G's, which means you disposed of 50 G's worth of Bitcoin or Ethereum essentially. So you'd have to pay taxes on capital gains on that 50,000 that you got rid of to purchase it. So it kind of evens out and it zeroes out.
right.
You get what I'm saying? I mean, maybe there's a way. I don't know. NFTs, honestly, like I said, I know how they're taxed, but like in general, I still don't understand them. Some people tell me that they're just going to go down into the dirt one day, and some people said they're the future. I don't know what they are. It's like a picture of a monkey that's worth like $30,000. I have no idea.
It's very
Crazy. All right, so buying and selling NFTs. If you buy an NFT using crypto, you'll have a sale transaction to report for the crypto used to purchase. So the NFT is now considered investment property, and it'll be added to inventory. So the basis will be the value of the crypto you just sold in order to purchase it. So if you purchased an NFT for $20,000, then your basis in that NFT is now $20,000. When you sell the NFT, you'll report the transaction on your taxes as a long or short-term capital gain. So essentially, that NFT is just treated as property. The crypto that you receive for selling it will then be recorded into inventory with the basis of with its basis being the value of the crypto in which you received from the sale. And that's it. So we'll take a few minutes to answer some questions. It's getting pretty late. If I don't answer your question, you can, like I said, reach out.
Yeah, what we're gonna do, guys, is we'll do a giveaway. All you gotta do is drop one question in here. We've got a few of them already posted. We'll probably pick one winner before the end of the session. So just put a question in the chat, and then I'll pick it out, and then basically, I'll tell you what the question is. But I'm just gonna scroll up because I think there was like someone had a question earlier. Is like, what if you have two accounts with the funded trader, but you end up losing one? Can you write off the full amount? You can't actually write off any losses you make in the account. The only thing you can write off is the challenges, right, Thomas? The
Right.
fees.
You can, and this is a misconception, and I should have actually harped on this a little more on the other video. The challenge fees are deductible if you're in service as a funded trader. So it's an expense to you while you're in service. So if you are a funded trader and you're incurring these expenses, you can write them off, but you can't just have all of these challenge fees that you're losing and write them off without being a funded trader. And I should have harped on that a little more because I had some people contact me
Now,
about that.
So I have a question. What if you create a business, right? And you're purchasing the challenges underneath your business. I mean, technically you need income to write it
right
off, right? So
I mean, essentially you need income because that's the only way that you're actually a funded trader. I mean, they may be considered startup costs eventually when you become funded. But it really depends on how old they are and really how you're treating this funded trading in general, because like I said, if you're creating losses for more than 2 years, then generally the IRS wants you to reclassify your activity as a hobby anyway. So it really depends on the person's situation. Once I speak to somebody and I can figure out what they're doing, I can let you know if it's gonna, be a startup cost once you become funded, or if it's not deductible, or if you are a funded trader and it is.
So we've got a few questions that are popping up here. I just want to jot them down. But
Okay.
basically the first question that somebody had that's pretty relevant. Let me see if I can bring this. And again, guys, post your questions in the chat. You're only gonna qualify for the giveaway if you actually ask a question. If not, you don't qualify for anything. All right. So if I signed up, all right, I'm gonna post this. If I signed up with my corporate firm that is limited by guarantee example, an NGO or a church. It's pretty wild. Can I have some form of tax exemptions on crypto? I know one can't sign up to TFT with a company name, but just asking.
Probably not. I mean, if you're, I mean, essentially, if you know, for example, like a, like I guess, is he saying like a church?
No idea. Going off of
So
that topic, maybe we could even turn this into like nonprofits.
yeah, that's a, I've never dealt with it. That's a really good question. I mean, if you're sitting there trading crypto through that, then that's probably not ethical. But if you're receiving it as donations and whatnot, that's a really good question. I've never seen it. Again, crypto's so new. Really in the past few years is what it started to become this really, really, really big thing. I'm gonna say within the last 3, 4 years. Before that, I don't really know if people were really even reporting their crypto transactions. But that's a great question. And if you want to send me an email, I can try to take a look into that and I'll get back to you.
All right, so we've got a few other questions here. The next one is, in the instance of receiving crypto as payment for sales, you mentioned we report tax for the income. One day the crypto will be sold and converted to dollars. This will then lead to a taxable event, double tax. Is there a way to avoid being double taxed receiving crypto as payment for selling goods?
Yeah, so I explained this through in the webinar. So you're going to pay taxes on that $5 you gained for the goods, but you're not going to be taxed on that initial $5 ever again. Your cost basis is now going to be $5, which is your starting point. So if you have a cost basis of $5 and that crypto makes it to $10, you're only paying the tax from what you've paid already. So your basis is $5 to 10. So you're not going to pay taxes on that full 10. You're going to pay taxes on that 5. The difference between what you've already paid taxes on, your cost basis now, and $10 what it's turned into. So essentially that's a misconception that you're being double taxed. I mean, yes, you're being taxed twice, but you're not being taxed twice. You're not being taxed on the same funds twice. You're getting taxed on that $5 you received, and then you're going to get taxed on any gain thereafter.
Cool. So next question, is it easier to buy and hold long-term to make things easier?
Of course. I mean, not easier. I mean, it doesn't matter to us, to tax professionals, or to somebody filing their taxes, so to speak. But for you, you save money. You know, you have a lower tax rate. Long-term capital gains tax is much lower than your ordinary tax rate, regardless of how much money you make. So it is beneficial to you as a taxpayer. Your tax liability is lower.
Cool. Next question. I'm going to drop it in the chat along with just saying it out loud. And I'm just going to send it to you directly, Thomas. So, do you pay tax per withdrawal, or is there a payment schedule whereas you pay on certain months or days? Thanks in advance for your reply.
What do you mean? Oh, like estimated taxes? You know, that's usually you pay them quarterly, which are for quarterly payments. So in the first quarter, let's say you realized, you know, $10,000 in capital gains. Depending on if they're short or long term, you should be able to estimate exactly how much in taxes you're going to owe, therefore how much you're going to pay in estimated taxes. But typically every quarter. If you want to look at our last webinar video on YouTube, I do show the quarters, what they are and when the due dates are, so you can go check that video out.
All right, next question. What are some tax credits, or what can we do to pay less taxes since the IRS is taking hardworking money?
I mean, I agree with you. Just because I do taxes doesn't mean that I'm an advocate for them, you know, doing this. That really, like, it depends on your situation. There's a credit for every certain situation. You know, for example, if you buy an electric vehicle right now, you'll get $7,500 deduction or credit or whatever, the the EV credit. So it just depends. If you bought an electric vehicle, you get that. If you didn't, then you don't. If you have children, you get the child tax credit. If you don't have children, you don't. It's, you know, just like people received EIP 3, you know, the stimulus payments. If you made under a certain amount of income, then you were able to receive that. If you didn't receive it, then they'll give it to you on your tax return. So it really depends. You know, one big thing is, you know, itemizing versus standard deduction. If you own your home and you have itemized deductions that are over what your standard deduction is, then sometimes you'll save even more money by itemizing. So that's one thing that we're able to do as well is look at your itemized deductions versus the standard and see which one's better for you to save you more money. So it depends on your situation. Everybody's situation is different, so there's really no universal credit or deduction, so to speak, that will fit all people.
Now, one thing I want to say, guys, is going along with the theme of this last question, the IRS is taking our hard-earned money. In my opinion, the more money that you guys make, the more you're going to realize how bad it is paying taxes. I mean, it's sad if you make $1 million, and depending what state you live in, I mean, say you live in New Jersey, for example, and when you have to pay $500K to the IRS at the end of the year, you are going to be finding that next year every which way you can avoid paying taxes. I'll tell you
Yeah.
that.
Yeah, that's why Florida, Texas, there's a few, I mean, there's like 11 states, but the two that I would
Even
move to if I
Florida,
had
man.
to.
I mean, you have to, guys, be smart. If you're gonna make a lot of money, open a holding company and then what? You pay the corporate. What's the corporate rate? 10% or 12% or something?
The corporate tax rate is standard at 20 right
Or it's
now.
like 21, right?
Yeah, it's Trump did that.
Yeah, it's better than, I mean, Florida, you're still paying the federal at 37 for personal.
Yeah, right.
You know what I
Well,
mean?
not well. you know, you don't want to hear what they were saying on the news today. They're starting with the raising of the taxes. So
I'm moving, dude. I'm literally moving to Puerto Rico. I'm literally moving. I have a friend that moved over there, and man, there's like one area that a lot of people live in because it's literally like a crypto land.
yeah,
It's like
yeah,
4% tax.
right.
And
Yeah, a lot of people do move there.
apparently you have to live there 6 months and 1 day in order to qualify for it.
Okay.
Dude, I don't know. One of the things because it's such a substantial difference. Say over the course of 3 years, you make $3 million, $1 million each year, and each year you're paying even the lowest amount, like 21% in tax per year. I mean,
Right.
you're losing out of 3 million. You're gonna have to end up paying like almost 700,000,
600. Yeah, 700. Yeah,
600,000 taxes.
it's crazy. I know. I know. And then you always wonder too. I said this to somebody the other day too. I'm like, where's our receipt? Like, where is this going to? Like, where did this money go to now? Like, did it build a road? Did it go into somebody's pocket? Like, whose
Just going
salary
into
did it
our
pay?
country's debt
Yeah, like I don't know.
makes no sense, dude. It's
No.
so wild, man. And like, that's why I'm like telling these people at the bottom that are like, raise the taxes. Like,
Yeah.
you guys have no fucking idea what's going on. Like,
Yeah.
you're trying
No.
to tax good people that made a difference in the world,
Right.
that are doing like literally creating jobs for the
Right.
people at the bottom.
Other people. Mhm.
Yeah, the people that need the jobs, like they're literally creating jobs for you people. And
Right.
then you're basically like, let's punish them.
Yeah. No, makes no sense.
Makes no fucking sense.
No. It's going into Nancy Pelosi's pocket.
Yeah, it's
I'll say
wild.
no more.
So we're gonna answer two more questions here. This one is it advisable one uses different accounts on crypto accounting software or spreadsheets on Excel if they use two different crypto wallets for different purposes, personal and business? Yes, that's what my answer is.
So the question is, should they have two separate?
I think they're saying if they have personal and business accounts, should they
Mhm.
separate the bookkeeping in the crypto accounting software?
Yeah, so that's different. That's actually a difficult situation because are you talking about business wise, as in like selling t-shirts or whatever like a good or service in which you accept Bitcoin? Because technically you really can't trade Bitcoin as a business unless you qualify for trader tax status, which it's kind of hard to.
So we have two other questions that are actually we actually have a couple like decent questions, so we're probably gonna ask all of them. Yeah, I
Okay.
guess
Okay.
hypothetically, say the business was selling t-shirts and then your personal is just like you have an account on Coinbase and then you have an account with there's one called like coin payment or something. So
Right.
for example, like let's even just use Forex League as an example, right? On coin payment, we have processor where people buy signals, right? They can pay in BTC and then it's on coin payment. And then we can choose to, sell that into cash or whatever, hold it in there. But that's all business stuff. And then my personal is, I'm on crypto.com, I'm buying USDC, I'm selling Bitcoin, whatever.
Right.
So that should be separate, realistically.
Right. You'll keep it separate. And then at the end of the tax year, obviously any earnings that you made in the business, you pay taxes on, and then any of the gains or losses thereafter would essentially be your private or personal gains or losses, usually if you're a small business.
All right, so let's get into the next one. Do you recommend an LLC if I trade Forex for a living?
No. No, because you're not going to be able to write off expenses as a spot, retail Forex trader anyway. So it doesn't make any difference. You're just trading Forex. It's just counted as ordinary income, usually under Section 988 for the most part. So I wouldn't really recommend it. I have seen YouTube videos of people saying that that's what they did for Forex trading. If they are writing off expenses, I wouldn't be surprised if they get audited and get in trouble, because unless you qualify for trader tax status, which maybe some of these YouTube guys who are big into Forex are, then maybe they can. But unfortunately, the smaller guys, then people working 9 to 5 who retail trade to hopefully try to quit their job one day, there's no need to file for an LLC, and there's no need to trade under an
I
LLC
feel like this
because
is also the other benefit of trading with prop firms because you're not actually
right,
trading, quote
right,
unquote. You're just a contractor. So it's like, say you open a business, an LLC, and you make a little Instagram page, right? And you're posting some educational stuff. Maybe you even make a little course. You're selling a course. Maybe you even buy a car, and you're doing some marketing. You're posting up you, shirtless on your car. You're like, I'm the man, all this shit. And then say the prop firm, you make some money, you're like you get paid out to your LLC, and Thomas, correct me if I'm wrong, say you make $50,000 that year as a contractor as part of your little business, your little educational business Forex thing, and you have some expenses, like you probably can write some stuff off in that situation, right?
right. I mean, as if it's ordinary and necessary for you to do your job as whatever you were doing within your LLC or whatever the case is, then certainly.
Yeah, like you can just be like, I have an educational platform. I'm showing that
Right.
I'm
You're
passing
teaching
challenges.
people. Right.
I do consulting, you know what I mean?
Right.
Whatever. Like you can spin it 20 different
Right.
ways.
Right. And and not only that, but when you're a prop firm trader, you are conducting business activity anyway. So when you're a prop firm trader, then you're good to go because you can deduct expenses. You're going to be issued a 1099, you're going to pay self-employment tax, and you're going to be you may qualify for the QBI deduction. So along with all of that comes writing off expenses as well. So
All right, so we've got two more questions here. I have an LLC for real estate investing, and I bought crypto with the same LLC, and I realized losses. Are the losses tax deductible?
are you a single member LLC?
This guy had no idea what he was getting into with that question. Let's say hypothetically he was.
If he is, then you're just that's I mean, essentially that's better because you're going to carry your losses over to your own Schedule D anyway. As a single member LLC, all of your activity carries into your individual 1040, with Schedule C, any of your business activity, and then any of your crypto activity would just flow through your own Schedule D. Yeah, so you're good. Everything's going to flow through an 8949 and Schedule D anyway.
Oh yeah. All right, last question. Let me see. Let me put this in here. What if we haven't had a payout from being funded and had losses through trading Forex on our own? Can we use all the losses as a deduction even though we haven't had income? I mean, what are you really
Losses
deducting?
losses on your personal account, he's saying?
Yeah, Esco, these are recorded.
If you're so he's saying he's not funded, but he has losses on his personal account. So if he has losses on his personal account, yes, you can deduct them in full as long as you have other income to offset. If you have no other income and you have Forex losses in your personal account, then you can't write it. It's wasted. You don't carry it over. But if you make $50,000 a year at your job and you have $20,000 of losses in personal Forex, yes, that 20,000 can offset that 50,000, essentially making your taxable income 30,000.
That's actually a good point. So if you're an entrepreneur, if you're self-employed and you're not a W-2 income earner, and say this year, fuck it, first year, I'm an entrepreneur, I'm self-employed, I have a $50,000 trading account, I lose 30,000 bucks and I have no income, there's nothing to write off.
You're out. Yeah.
You're out. You're just losing. You're negative 30. But if you have a W-2, to Thomas's point, you made 50K in salary that year, but then you have 20K in losses, on Forex, then you can actually use that to offset the W-2.
Right. All right.
All right, guys. So that's pretty much it. We're going to pick one winner for the giveaway. XD, he's the winner. I just did a little random scroll. So you want a challenge, just on Discord, send us a message, create a ticket, and then we'll send you a free 50K challenge. We thank you guys for hopping on the webinar. It is recorded, will be posted as soon as possible, and all the questions will be posted with timestamps and everything. And as always, Thomas, thanks for hopping on and helping us out.
Thanks for having me. I look forward to doing more in the future. If you guys have any questions, feel free to email me. All right.
Yeah, maybe tell these guys where they can find you and stuff like that.
Okay. So you guys, feel free to, go to the website, traderstaxpro.com. You can contact me there and it'll send an email. Sometimes we have live chat open. Usually I'll hop on that. It comes to my phone. You can also DM me on Instagram. If you guys don't already, please go follow me on Instagram at, Traders Tax Pro. I'm also on TikTok. I think I have one video up, but maybe I'll do more when tax season's over. I really have no time for social media right now. Yeah, I'm also on Facebook. So wherever you feel necessary to contact me, then definitely, yep, Instagram, follow me, Traders Tax Pro.
Yes, sir.
Nope.
And
No
tomorrow,
problem,
guys, don't forget, we're going to be having the community webinar at 12 p.m. Eastern time. So we're going to be doing an update on basically March, going over all the stats for the month and everything like that. So hope you guys enjoyed the session. Thanks, Thomas, again, and enjoy the rest of the night, everybody.
Good night, everyone.
Peace.